Since my last video for a potential market crash in 2020, a lot has happened to say the least. Minus 12% in a week, the worst drop since 2008 financial crisis. This kind of drop in a year is already out of the ordinary. Looking at the chart for the last week, it looked like the Grinch's Christmas. It's the dip that just keeps dipping. Then on Monday, the Dow rocketed up 1,500 points, the best single day gains ever. On Tuesday, the Fed cuts interest rates by 0.5%, and the index swung around 1,300 points to end the day dropping 900 points. On Wednesday, it bounced up 1,100 points. Mind-boggling numbers. This roller coaster certainly isn't for the faint of heart. So now we have to question ourselves. Is this week's rise a dead cat bounce? Or a real V-shaped rally to new highs? If it is a dead cat bounce like the graph is showing, we'll match it to the Dow Jones chart. Say the top here is 29,500, the bottom at 24,500, so that's a difference of 5,000 points. Retracement of 50%, which is 24,500 plus 0.5 times 5,000 equals 27,000 points. At the end of trading day Wednesday, we're back at 27,090. Then we're right where this point is, number 3. Then we all know what happens after. Or have we already found the bottom and things will just get rosy from here? What kind of triggers? Could we look back in a couple months or a year and say, yeah, that's definitely the bottom? Could have seen it from a mile away. Can Trump's words save us? Further rate cuts from the Fed all the way to 0%? Or maybe the release of virus scanner that can wipe up the coronavirus within minutes. Welcome to Money Insiders. My one and only goal is to increase your financial literacy by 1% every video. If you're new to this channel, do consider subscribing and dropping a like to show some support. Have you ever been at a roulette table at the casino and made some predictions for the next outcome? Either if it's red or black, odd or even, or your lucky birthday numbers. You're making a guess based on different factors. It could be the history for the past 10 rolls, hot numbers that came up more often than the others, or a simple gut feeling. We make these predictions all the time. When they're correct, we collect the chips and pat ourselves in the back. When we're wrong, we just move on and repeat. So why don't we make some predictions as to what can trigger the market bottom, shall we? Historically, the bottom is generally found when the worst news is out of the bag, and there's nowhere to go but up. Following the buy on bad news, sell on good news as a rule of thumb. Number 1. Red alert. One of the most obvious one is when WHO finally announces global pandemic. So far they've only acknowledged the coronavirus as an epidemic, but in various parts of the world. Looking at the map of infected countries, I don't see how this isn't a pandemic. It just seems like the WHO is waiting for Trump's go-ahead before they can announce anything. So far this week, Trump held various meetings with pharmaceuticals and major airline companies to see if the United States can contain the virus before releasing the statement, which can cause a lot of panic. We look at the infected countries, Japan in particular. For those who have been to Japan, you probably agree that is one of the most hygienic countries in the world. Yet they have 1,000 plus cases, although 700 of them came from the infamous Diamond Princess cruise ship. They've also closed all schools until April and canceled various sporting events leading up to Tokyo 2020. That brings me to number 2. Canceling huge sporting events. Japan can cancel Tokyo Olympics 2020, which is occurring this July and August. They already canceled the marathon for February 29th and rugby test event in April 25th. If this does happen, it could be catastrophic for the Japan economy. We all know how much the local businesses rely on these events. Think about all the merchandise that will go to waste, as nobody would pay for a Tokyo 2020 mascot if the event doesn't even exist. There have only been 3 other cancellations of this global sporting event. 1916 from World War I, 1940 and 1944 from World War II. Think about the fear on the streets when this event is cancelled. The 2020 Games has approximately $1.3 billion in sponsorships. Notable global companies include Alibaba, Coca-Cola, Procter & Gamble, Samsung, Visa. Sporting companies include Nike, Adidas, Under Armour, Asics, Puma, Anta Sports, etc. etc. It will be televised on ESPN, TNT, and CBS. If the event cancels, all the marketing expense from these companies have gone down the drain, and their projected revenues from the event also goes to zero. A lose-lose situation. Another event is happening in the States just 10 days from now, March 15th. Yes, it's the March Madness. The NCAA basketball tournament is a huge gathering that brings in all the college players, parents, fans across the country, essentially moving 500,000 plus population for 2 weeks straight. These people will be trapped in planes, hotel rooms, and stadiums for more potential to pass on the virus. Side note, Warren Buffett's March Madness Bracket Challenge. Back in 2014, he offered $1 billion to anyone who can guess all the winners of the March Madness matches. The odds of getting it right is 9.2 quintillion. To put that in context, it's million, billion, trillion, quadrillion, quintillion. That's also the same as a billion, billion. There is only one condition to win the $1 billion. The contestants has to be a Berkshire Hathaway employee. And I really don't think anyone won this challenge. Number 3. The US lockdown of all the flights. It all started with blocking China in late January, then limiting these countries, Korea, Italy, Iran, Japan in recent weeks. When the list compiles to a dozen or more, I'm sure the thought would be on the radar to block all the flights. I recently flew within the US and noticed throughout the security check-ins to gate boarding, I only saw one person with a face mask on, but 30 plus either sneezing or coughing. In the departure gates, as we can see, nobody was wearing any face mask and their proximity is within arm's reach. The ventilation is trapped, circulating in this virus-prone incubation center. I also noticed a lot of coughing on the flight. The amount might be similar to flights in the previous years, but things are extra sensitive during these times. Eek. Number 4. Corporate debt bubble. It has been known that there is $9 trillion of corporate debt just in the US economy back in 2019. I know it's nothing compared to the quintillion that we mentioned earlier, but it's certainly a huge amount. Due to supply chain issues and companies being over-leveraged from the cheap money floating around, small medium cap companies may file for bankruptcy. If several of these happen, it'll trigger the domino effect where only the largest companies in their industry have the cash reserve to survive this recession, possibly just hanging on from government bailouts. With the recent rate cut of 50 basis points, the interest rate is now 1.15%. It'll further fuel the fire. Number 5. Greed bubble. The complacency in the market over this 12-year bull run is ridiculous. After every pullback, new highs are reached within months. This cycle isn't normal. For new investors that just got into the market within the past 5 years, their gains are 100+%, so this 12% correction wouldn't create any panic sells. I recently did an experiment saying the Monday rally was a dead cat bounce, and markets would be lower in the next 2 weeks. Then these 2 users simply said negative and wrong, without any reasoning, because they're so wired to the bull run. With this guy as a cult leader, they only have one belief in this market: just keep buying under any condition. The blind mice will follow even if the path leads to a ditch. The market is a zero-sum game. All the newcomers have had a heyday for the past 12 years. In order to make them pay, we need unicorns to lure them in to go all in. record highs in the market, and the euphoria that the market will always trend upwards no matter what. The blind mice generally won't sell for two main reasons. Number one, they don't want to pay taxes for their huge capital gains. Number two, FOMO, or fear of missing out. What if I sold Tesla at 600 and went to 9,000? In order to solve number one, a huge shakeout is required, maybe 35 to 50%. That will make the portfolio as a whole in the red. Then they'll reconsider life decisions, protect their assets, and possibly sell. Since selling at a loss doesn't require you to pay taxes, right? To solve number two, their unicorn stocks needs to tank 70+% from highs and suppress any significant bounces to bring them back to reality. Then they'll sell and find other shiny vehicles to invest in. For example, Tilray hit a high of $300 back in September 2018. Now is at $12.50, minus 95%. We'll look at these three unicorns in particular: Tesla, Virgin Galactic, Beyond Meat. Tesla had a high of $9.69, now is at $7.50. Virgin Galactic had a high of $42, now is at $24. Beyond Meat had a high of $2.40, now is at $102. Say if it drops to bear market levels, minus 30% from highs, 29,500 times 0.7 is 2,500. Triggering both these selling mechanisms, it will cause the panic sellout market and drop the needle 2,000 plus points to find the bottom. I may be sounding like it's all doom and gloom, but I believe it's healthy to shuffle the deck once in a while. Have some patience. We don't have unlimited ammo to fire and buy every time the market drops 2 to 3%. We can always wait for stabilization, or implement a dollar cost averaging strategy to buy monthly and get rid of the emotions of following market headlines. So what do you think? Have I increased your financial literacy by 1%? If yes, then consider subscribing, hitting a bell, and dropping a like. Otherwise, you can comment and let me know how I can create more value for you. Take care and have a good one. Check out these video links if you want to learn more about various stock market investing strategies.